Well, welcome back to the Wealth Transfer Podcast. Today I have Tim Pawul, who is probably the foremost expert, or at least media voice thought leader in oil and gas, minerals and royalties. And he has an advisory firm that helps people, whether they're looking to acquire mineral interests or whether they're looking to sell. And I'm really excited for him to unpack kind of the behind the veil of what goes on in the mineral and royalties area. He has the #1 podcast in the industry, the Mineral and Royalties Podcast. And I think we're going to get some great insights, maybe even some behind the scenes information on how that world works and where you might have an opportunity, whether you already own non-operating interests that you're looking to transfer to your next generation or looking to sell, or whether you're looking to maybe move some investment income or assets into that space. I think you're going to find this super valuable. Welcome, Tim.
Matt, thanks for having me.
Tell us a little bit of your background. How long you've been in this space? How did you get into minerals and royalties and understanding the oil and gas industry?
Yeah, for sure. It's a bit of a roundabout way in how I built the business. I think most entrepreneurs, when they look in the rearview mirror, can typically tell a story like that. But it was right place, right time, Matt. I would say 2013, 2014 was the beginning of the quote unquote institutionalization of the oil and gas minerals asset class. Minerals are not new, but public companies, private equity, funds that are 50, 100, 300 million in size with family office capital and pensions, et cetera, that never existed. And so 2013, 14 was really the beginning of that. And I just happened to have curiosity at the very, very ground floor level to where I started meeting with all the CEOs. And then more companies would pop up. I'd meet with them. I get referrals to some more low profile players like family offices that own these things for decades. And that's really how I built my expertise. I've essentially spoken to everyone over the last 12, 13 years that has a fingerprint on this space: advisors, brokers, private equity firms, publics, aggregators, all shapes and sizes. And that's just beating the pavement, knocking on doors, one meeting by one meeting. And then when I started my podcast in 2020, that gave me a public profile to now I have the real honor of just having people come to me because I have this central voice and this platform where I'm speaking to CEOs on the air all the time. And it's just a really interesting place to be. I'm kind of at the center, the eye of the storm, if you may. And I'm in a really privileged seat to have the smartest people in the space come to me, not only to work together on mandates, whether it's raising money or selling or buying assets, but trading thoughts. Hey, here's what I'm thinking about. Here's the most cutting technology. Here are the trends basin by basin. All these things I usually get some sort of pass at. And I can make intros, play traffic cop, like even if I'm not directly involved in something, whether it's the biggest companies in the industry or the smallest, I'm involved somehow typically. And that's a really cool spot to be because there are a lot of incredibly innovative, smart people in this industry, and you get to see what's on the forefront. So, thanks for having me on it. It's very humbling to be able to do these things and speak at conferences. I would say to your audience, why would you listen to Tim Pawul and take any weight on what he says? My thoughts are a culmination of the smartest minds in the space and 12 years of ongoing intel. And now all I do is speak to CEOs every day and investors. So the comments I'm going to share, the answers to the questions you ask, it's very much going to be like a combination of what 20 CEOs have told me over the last few months or years or some version of that. Just to give you, lift the veil on and the curtain a little bit on what's going on upstairs for me.
I absolutely love that. And I definitely want to get into some of those interesting insights. Even before we get there, break down for us, because I think a lot of times we have friends, we have colleagues that own minerals interests, or maybe we have family members. We've maybe heard of people working in this space, and there's a lot of jargon in the space. There's a lot of like ambiguity, and it's sometimes uncertain. Like, do I own the land? Do I have a leasing interest? What are all these things? Break down for us, like how, just a basic understanding of the industry and how these things work, so that those that maybe don't currently own anything have a little bit better understanding of how your industry works.
For sure. So I've always found the simplest thing is to do a bunch of analogies and metaphors to things we already understand, right? Triple net lease of oil and gas. That's what minerals are. They don't have costs. So you get paid a percentage of revenue based on oil and gas production that an operator like Exxon is out in the field, exploring, producing, extracting, and selling downstream. You just get a percentage off the top of that. You're not involved with the equipment, the field personnel, the planning, none of it. It's a truly passive investment. And once you pay for it, or if you've inherited it, there's no ongoing capex or operating costs, which is very unique. So in the real estate world, triple net leases are the simplest thing I can think about. Think of it as underground real estate for oil and gas as well. You actually have lots of different estates. You have the surface estate, the water estate, the minerals estate. I mean, I can go on and on. There's all these different bundles of sticks of value when it comes to real property ownership. And that's really, mineral rights are just underground oil and gas real estate. And there is a cottage industry, and this is what I traffic in and where my expertise is, of funds that go and buy these fragmented interests of this underground oil and gas real estate, and they assemble portfolios that investors find attractive, that have a certain amount of yield, a certain amount of growth, and a certain amount of diversification. And they do that by putting Humpty Dumpty back together again, right? I mean, what happened, this is the only country in the world where you have private ownership of mineral rights. There is no other country in the world that has that. The government owns these things. This is one of the most valuable asset classes in the world. A signal of that is the United States is the only country in the world that the government has handed over private ownership. But what's happened is over the last 150 years, that private ownership has been fragmented through estate planning and generational wealth transfer. I think that's a topic very fitting for this podcast. And then trading, right? Transactions, people horse trading, gifting assets, whatever it may be. The result is there's tens of millions of individuals that own these fractionated interests. So I'll pause there, but those are a couple of kind of quick highlights. And that there's specific things kind of that you hear from conversations with your clients, Matt, on, hey, what does this jargon mean? Or, this terminology, I'm happy to answer that specifically.
When you brought me on your podcast, which I was super thankful to be able to do, and we talked a little bit about 1031 exchange, which I think a lot of times people don't realize that because these are real property interests, just like owning a building or owning land or these other aspects of real property, you can 1031 exchange another type of real estate, a commercial property, a rental property, something you've owned for investment into mineral interests, and defer your tax gain until a later time in the future. Usually we tell people you want to roll and defer until death because you get that step up in basis. But what if somebody was looking to maybe sell a large commercial building and they say, I want to go more passive in the type of assets that I own, and minerals sound really interesting. I've got a lot of friends that have made a lot of money in minerals. What's the path to maybe starting out, or I mean, maybe they've already got a nice estate, but they want to start diversifying into minerals. Is that something you can help with? Is that something that's available to the average sophisticated investor?
Absolutely. So there's a number of different paths. If the whole idea is you're going to monetize a piece of real estate and you're going to have real estate proceeds, you want to go the 1031 route, I'll pause on going into the details of how 1031 works. It's the same exact as if you did it in real estate with the 45 days and the identification and, the identifying the asset and all that. But, let's just say you have, for simplicity, $1 million of proceeds. Well, what are your options if diversifying into oil and gas is of interest? You can find an oil and gas minerals DST. I think that is probably one of the easier things you can do because you don't have to identify or underwrite the assets. You're going to be going into something that has been built already, that's diversified. A couple groups off the top of my head that are, have long track records in the industry are Montego Minerals and Resource Royalty. So those are a couple names that people can check out. One of the other options is, and we talked about this when you came on my podcast, is the quote unquote lazy man's 1031. And that's going into an IDC fund. So it's not a 1031. You would actually just sell the real estate traditionally. You would have capital gains exposure. You could then allocate to an oil and gas fund that is structured in a way that they do a GP flip, it's called. And that GP flip gives you temporary exposure at the GP level. And then you revert to an LP after the well commitments have been made. Just stepping back very briefly, why is it structured like that? In the tax code, as long as you have quote unquote unlimited exposure to the drilling activity, you get to write off active income, whether it's capital gains or 1099 income or W2 income. But a lot of people say, well, I'm not an oil and gas investor. I don't want to go directly into an LLC, and I don't know what I'm doing. And typically, if you're going to go into an LLC, it might be very concentrated with risk as well. There might be 2 wells or 3 wells, and I don't have to go into statistical diversification and the downside risk protections of that. I think a lot of sophisticated investors know that. So obviously, you want to be exposure to 100 wells instead of 3 if you can. So capital markets, free market, always find an efficient solution. That's what we love about Western capitalism. They said, well, let's give the opportunity for folks to get this great tax benefit, but get them into funds. So what happens is you go into the fund, you allocate the capital, you get the tax write-off, which is typically around 90% in the year one, which is phenomenal. And then as soon as all the well elections are made, not drilled, just the well elections, you flip back to the LP. So in a lot of these funds, you have GP exposure for anywhere from 1 to 6 months typically. And there's a variety of other things, GP insurance, et cetera, to mitigate that risk. So obviously speak with your tax advisors and attorneys and everything when you're vetting these things. But that is an option. In that world, I like non-op IDC funds. Non-op IDC funds have lower cost drag, they have more diversification, and they have more flexibility to move as commodity prices move. So in the beginning of the year, if oil is attractive, you want to go to oil deals. If oil, drops to $40 or drops, skyrockets to 100 like we had, and then you're worried about, overpaying and it going back the other way, you can pivot to gas, you can pivot to different basins. And so a non-op model is really attractive from that perspective. A group, that I really like and I've actually personally invested into is called Shale Haven Partners. So that's a non-op IC fund. So that's a candidate to consider there. The other, and this is actually something I'm not super knowledgeable on, but oil and gas trusts that are publicly traded, they're having an interesting moment in time right now. Trusts, the Sabine Royalty Trust has been around since the 80s, but you can actually 1031 into a publicly traded minerals trust. So some of these trusts, TPL was a trust that then got repurposed into a corporation so it could actively grow because the asset base it inherited was so incredibly valuable, and they felt the shareholders felt if we can have a management team that goes in and actually builds this thing proactively, we can create more value for shareholders. You have Blackbeard Holdings and some other entities are looking at doing something strategic with Permian Basin Royalty Trust right now, where they're going to, it looks like, repurpose the structure to do things around water, data centers, minerals. And then, you've had a number of conversations around if you want to go public, do you do it through a trust shell? I was talking to a banker earlier today that specializes, them as an investment bank have traditionally specialized in these trusts, where as you start to have large diversified mineral holdings that are yielding a lot of income and there's a natural buyer for that in the M&A market, do you just set up a trust and now you don't have to manage the asset? A trustee does that. You get public liquidity and you still get access to the income. So that is something from a 1031 perspective, that's another option on the table. And again, that is going to be low friction because it's going to be the units per share or dollar per share in the units or dollar per unit, how many proceeds I have. And it's a publicly traded liquid vehicle for you to go into. And then the last one is you go into an asset directly yourself. So this is where an advisor like myself would come in. I could help you find the target asset. I could bring in the right counterparties, whether it be title attorneys, engineers, et cetera. I could help. It's almost like if you're building the pool, Matt, the pool contractor actually doesn't do, they don't actually dig the pool and put the cement and do the decking, they go to the decking guy and they go to the concrete guy and they're the project manager. I would be the project manager essentially. And I would be able to understand the risk profile you're trying to achieve. I'll give you two examples. You might have someone who's in the latter part of their career or their life where they want steady, low risk income. Others might want a little bit more upside and something that just has some longevity that they could keep in the family. That's going to be a very different type of asset you 1031 into, right? So that would be something where you have to identify the asset, underwrite it, be competitive in the market. I particularly think it's easier to do it with a counterparty that owns the asset already instead of going to someone who's trying to buy an asset and then place with you. It just adds another layer of complexity. But there are a lot of really good firms out there that actually specialize in placing assets within 1031 wrappers. They know the structure, they know all that, and they specialize in doing that with high net worths and family offices. So those are kind of the four main routes. One thing to point out, if you're not super familiar with 1031s, you cannot 1031 into a fund typically. So it would have to be asset to asset. That's the one thing, and that's what makes the trust, or the trust option, the DST option, the lazy man's, non-op IDC fund option attractive, because it's a lot less work, right? But it all depends, it's horses for courses. Every investor has their own style, and some like to roll up their sleeves and some want something a little easier.
That's phenomenal. I mean, this is probably this is a super valuable little piece. On the IDC funds, you don't even necessarily need a 1031 or a lazy 1031 at that point. You could just have funds that you've got sitting on the sideline. Do you know what the minimums are on those funds?
So those are typically more retail driven. So the minimums I've seen are 50,000, 75, 100,000. It varies fund to fund, but those are typically engineered around high income earners, right? So
yeah.
If you're a doctor, if you're on Wall Street, there's pilots are a big segment of that. Anyone who's generating a lot of income and has disposable income to invest, and they just want to lower their exposure. The other thing is, if timing wise, these are typically annual funds. So if you sell a business or sell an asset and you got this big tax liability, this is one of the ways to solve it. And, as I mentioned before, like, I started this path in 2013, 14. It's a relatively young part of the industry when you talk about the institutional era. The whole concept of taking the IDC fund and applying it to non-op is also extremely new. So the IDC's funds were typically operators. And, with operators, you have larger teams, more concentration risk, higher G&A that gets pushed down to the investors. So, kind of eats into your fees a little bit potentially. If you have a gas position and gas, craters on you, it's not like you can just pick up your equipment and go have other leases in the Permian instantly. So there was always some barriers there in the past. And then going into these, I call it like the country club deals, right? It's, Bob used to work for Chevron and he's coveted this asset in Louisiana his whole career, and he's done some seismic on it, and we're passing the hat. He needs $10 million. That happens a lot, and it could definitely work. Like, if it works and all the stars align, you might get 100% IRR on it. But there's a lot of things that can go against you: pricing, cost inflation, just the well gets delayed a little bit, and those investments become very, very sensitive. And so what I find typically is when folks non-industry are coming in, they're looking for tax efficient solutions. They don't need to take excessive risk. They don't need to swing for the fences and get 5 and 7 X's. They want to stay in the middle of the fairway, get good solid income and yield, something that's not taking on too much risk, and then get the tax efficiency they're signing up for. And that's the beautiful thing about the unconventional shale revolution. We're about 20 years into it now in oil and gas. And for everyone listening, there's kind of conventional development and unconventional development. without getting into the weeds, unconventional development and shale, just think of it as technology unlocking a better way to get more volumes quicker. That's just the easiest way to think about it. And so the scale of oil and gas production in the US, we've gone from a net importer or net exporter in a couple of decades. And we're an energy superpower now, and it gives all sorts of advantages when you're the United States from a policy perspective, right? When you're not beholden to other countries and imports, et cetera. So, yeah, what I was getting at, bringing up the shale revolution, we're at a stage now where we're not testing stuff. It's not science projects, right? A lot of it is just manufacturing mode. If you've ever flown into Midland, Texas, and you look out your window, you will see squares as far as the eye can see, and within each square there'll be 8 little dirt patches. Those are well pads, and it is symmetrical. And what that is systematic drilling and development where an oil and gas company goes in, they know what's in the ground, they know how to get it, they've done it hundreds and thousands of times. If they haven't done it directly, someone else has. They can get that offset data, and oil and gas production is really more statistics than it is science and geology in a lot of these core areas. At least in the areas where you're doing these tax efficient products, that's where I recommend people go. You don't need to take on the excessive risk. Narrow the variance of outcomes. It's still very attractive. We're talking high teens to 30s IRRs depending on the project. Net, without the tax benefit, and then tax benefit on top of that, it's phenomenal. So
Oh yeah, I mean the IDCs like that absolutely. I mean, it reminds me, and Lazy Man 1031 we use in the real estate side too to talk about selling your real estate without the 1031, and then doing buying another property and doing some bonus depreciation and some cost segregation, et cetera, to make the tax kind of equal out. But it sounds like going the GP route and being able to take off these taxes in year one is phenomenal for, like you said, high income earners. And love that note. The other thing that you said earlier that I have forgotten to bring up, but I love the publicly traded royalty trusts. And anyone can, you don't have to have a 1031. You can just you can go into your normal investment account, any retail investment account, and go buy those SJT and PBT. And I think is it SBT or one of those, Sabine, whatever the Sabine one is, and own those. I was playing with that a few years ago because I was trying to understand, could somebody actually 1031 into these royalty trust interests that are publicly traded? And yes, you can. Now, I'm not an investment advisor. You, I think, are, but I am a real estate advisor. What I do tell people, if they're thinking about that, is make sure that you have somebody that's advising you on which of these are performing, which ones have good longevity, because there is some volatility both on pricing and also on whether they're going to perform for the future. And obviously, if you're 1031ing from a very stable asset into a potentially volatile stock price, it's awesome if your investment goes up 30% in the next year because it's performing well, and you've gotten the 6 to 9% returns in monthly cash distribution that those dividends usually have. But it's also not awesome when you're ready to sell 2 years in and all of a sudden you're 30% down on value just because of the timing of the asset. But they are great for moving quickly.
Yeah, Matt, I will say the trust. So, I mean, I've been in the weeds in this space. I mean, everything you can think about, every player, et cetera, for 12 years, as I mentioned. The trusts are almost like invisible to the players in the space. No one talks about them. When you talk about the public space, you talk about Viper Energy Partners and Kimball and Dorchester and TPL and Freehold, et cetera. You don't talk about Sabine, right? Because these groups are not actively doing anything. It's just now that they're starting to come back into the conversation because of how they're being used tactically. In the public space for minerals, it's not a huge public space. It continues to grow in terms of like the market cap of each company, but what's happening is they're all starting to settle into their own niches. So typically if you want a very tax efficient solution for selling your mineral interest, you go to Dorchester. Dorchester's structure, again, you can look at their docs and understand it, but there's a lot of folks in Texas who say, I don't necessarily need to sell my minerals. I don't want that tax liability or having to go do a 1031, et cetera. I would like a little bit of liquidity or a little bit of extra diversification or the option to have liquidity. Dorchester cannot do any cash transactions. It has to be like-kind units for minerals. So if you were to see their shareholder base, it is a lot of Dallas, Midland, Houston family offices that own minerals that contributed over the years. So like that's a niche, right? And then Viper has been the one blowing and going, rolling up these monster Permian portfolios. TPL has water and data centers and surface and minerals in the Permian. Like that's very unique. Kimball's more diversified, so they can buy anywhere. So it's like, and then you have Whitehawk just IPO. They're natural gas only, so they're the first of its kind. So you're starting to see like the chessboard being set up, and there's these very different players that when an asset comes up that has a very specific feel to it, there's someone who's likely more logical to go and buy that.
Well, then Dorchester, you're getting shares in the company for bringing your asset there.
Correct. They can't go and say, Matt, your asset's worth $20 million. We're going to pay 20 in cash or shares, which is how normally publicly traded companies do. They only do for units. They don't offer any cash.
Well, and that is probably under the IRS code 721. So that's where we talk about the two types of exchanges, 1031 or 721. In a 721, a REIT or a fund absorbs your asset. And so it's harder when you've got random single family or a commercial property no one wants, but it's easier when you've got an asset like mineral interests. They're absorbing that, and then they're trading you shares of their fund or shares of their company in exchange for that. That's a 721 exchange, which is the sister to 1031 exchanges. And I mean, it could still be under a 1031, but I'm pretty sure that's probably a 721. And we talk about 1031s and 721s a lot because that's my industry, real estate. But I do love this, and so I hate to harp on that because I love to hit a diverse amount of conversations. But I love that in mineral interests or in these royalty trusts or even potentially in the Lazy Man IDC piece, you could buy something. Maybe you buy a property, maybe you go into a DST, but you have some extra left over that you want to put into something else. You could go do part, like when you're doing 1031, you don't have to buy just one property. You could split it up into multiple different places. And maybe you take some off the top or some that's left over at the end and you say, I'm going to go play a little bit of a royalty trust game and I'm going to take a little bit from there. I'm going to go, do the lazy man on the rest of this and do, although we want to double check with the 1031 advisor, make sure we're not potentially risking our whole 1031 for that. But there might be some other ways where you could split it up and get some diversification in different asset classes that way too.
Yeah, the other thing I'll mention too, one, when we talk about IDC funds, that is specific to non-op working interests. So minerals do not have drilling costs. As I mentioned in the beginning, you don't have cost exposure. So I don't want to confuse the audience. Like the IDC fund structure is specific to non-op. You can't do that with minerals. So that's number one. Yeah, I think what's on the 721s, we talked about this earlier. I'm not as familiar with that. That's probably actually what Dorchester is. I just don't know the nomenclature for it. It's fascinating. I think one of the other things when you talk about why you would 1031 into minerals from real estate, let's kind of have that conversation. One of the things that is different between minerals and real estate usually has a pretty high, LTV, and minerals typically have no equity. So that can be a potential bump in the road where you have to, pay off that debt, out of pocket or right size it somehow. You can definitely put leverage onto minerals if there's production. The typical lending that commercial banks will give on oil and gas production is going to be 24 to 36 months of your last 6 months cash flow average monthly cash flow number. So if that average is, 10,000 a month, multiply that by 24 to 36 months, and that's the line that they'll give you, and that's the leverage you can apply to an asset. So you typically will never, like a full PDP asset, or PDP stands for production, a full producing asset, it's going to be hard to get it over 50% LTV. And you have real estate going up to, I've seen certain groups 80%, right?
Yeah.
So if that's what your real estate asset looks like, that could be a challenge to go into minerals. One thing going back to being the project manager, I'm the guy helping you build your pool. Alan Brown, the president of Petroleum Strategies, they're a QI out of Midland. They are really the OGs and the leaders in energy 1031s, in my opinion. I did a podcast episode with Alan a couple years ago, and he was just open kimono for an hour and a half on every nuanced scenario he's seen in 30 years related to energy 1031s. They've done 50 billion in energy 1031s, which is a big number. So he was a wealth of knowledge. I always point people to that podcast episode just to get educated. And then I always introduce him. Alan's always happy to be taking calls and meeting folks, and he can kind of look at your asset and say, these are the things you need to be concerned about, or this is not really going to be a fit for oil and gas, or it will be for these reasons. That's his area of expertise in his domain. And I usually use that as his first step, right? Hey, why don't you talk to Alan and see, what structure holds your real estate? Like that can be a barrier sometimes. I went through this process with my father. He's liquidating a business real estate asset. He's retired now. And this is one of his final liquidation events. We looked at tax wrappers. We looked at IDCs. We looked at 1031s. And the way him and my uncle own that asset 50-50 inside an entity with the leverage on it and that structure, it was really difficult to get it into oil and gas. The non-op IDC fund actually was the most attractive option that he ultimately went with. But every situation is going to be a bit unique, right? And so that's just one thing to point out. Now, whether you're transferring, proceeds from real estate into minerals outside of 1031 or inside 1031, one of the attractive things could be interest rate arbitrages in market cycles. Because you're not using any debt in minerals, when interest rates spike and deal flow locks up in the real estate space, you might find yourself struggling to find something that is interesting to 1031 into. You can 1031 into minerals, and you kind of get that hedge on interest rate environments, and maybe interest rates go back down and real estate properties start to become really interesting. You can 1031 back into real estate, or some iterations of that. There's a lot of oil and gas fund managers that specialize in minerals, but also specialize in real estate, maybe got into real estate first, went into minerals, or vice versa, that just do this daisy chain back and forth, right? Playing the tax arbitrage, playing the market cycle arbitrages. And if you can understand that, it's really interesting, right? And I think when you specialize in something, I'm not a real estate guy, but whenever I meet with investors and family offices that really make a lot of their wealth in real estate, it's the niches that they specialize in, right? And it's the same thing in minerals. And if you can get smart enough on both of these and kind of rifle shoot the opportunities in both and play them together in a portfolio, I think you're cooking with gasoline, right?
Totally. Yeah, and so this brought me, and we do have a number of clients that own their real estate in cash, right? Some people like to use leverage, some like to have it all paid off. And sometimes you have certain assets that are paid off and others that don't. And so we can come up with a strategy around that. Sometimes we're trying to get the stuff that's paid off and get it leveraged so that we can get cash out before we do a 1031, but there's always a different strategy. That's why we do planning.
So Alan, I'm forgetting what that's called. I want to call it like a post 1031 financing or something, where essentially you're recapping the asset afterwards to get some cash out, right?
There you go. So there is an option potentially for that even on the...
Correct.
But that brought me to, and the question that I thought of was, so how do you value, especially when you're talking about specific interests, how does the industry value those assets? How will somebody know, like, here's kind of the going rate for an interest and what causes things to be both more valuable or less valuable?
Yeah. So that's the $1 million question. Unlike real estate, where you have pretty clear comps and you have Zillow and things of that nature. And if you're in a certain zip code and you have certain square footage, certain amount of bed and baths, a pool, whatever, you can kind of figure out the dollar per square foot, right? And there might be, my wife just falls in love with this certain house and we're willing to pay a little bit more. There's always that dynamic, but minerals are very different. I think this is one of the things that scares people about getting into oil and gas, is just the complexity of understanding it. That's why, I always say, as long as you're alongside professionals that know what they're doing, it's a great asset class to get into. Don't close that door just because, it's too complex, you can't understand it. But don't kid yourself. There isn't going to be a Zillow where you go online and you go, oh, this is what it's worth. There's the neurology, just like real estate to a certain extent, but there's an understanding of what's going on below the ground, right? This is subsurface oil and gas real estate, as I mentioned. And there's all sorts of variables that go into how much value your minerals will be worth. You could be in two units side by side. One unit could be worth way more. And why is that? Well, mineral rights are actually oil and gas molecules trapped in rock below the surface. And in each formation, some formations are more porous than others. There's a variety of geologic descriptions and factors that go into whether it's more economic or less economic to drill and extract that for an oil and gas company, right? And so all those different factors go into it, into determining how much oil and gas you can actually extract out of that, how much it's going to cost you to do that. And then, if there's faults, if there's certain types of water, underground, like there's a variety of things that can make it less attractive. You might have H2S. These are things that that can be very dangerous if they're emitted into the air, and so you have to have extra infrastructure costs to like contain that stuff. Is there infrastructure in the area to take away the gas and the oil? Does that need to be built? That's a risk that you're waiting on that stuff to be built. Is there water takeaway? So on and so forth. There are so many variables, Matt. Like what makes my seat really fun is, I get to see the way everyone skins the cat in this game. And what minerals buying is and minerals underwriting, it's taking imperfect signals and combining them into a thesis to then buy and predict development as it's going to happen. When you're buying existing production, that's engineering, right? For the most part, you can guess, okay, this is producing 10 barrels a day. It was producing 30 barrels a day 2 years ago. You can kind of fit the decline curve and you can statistically kind of figure that out. It's what's going to happen in the undeveloped location. One, if it's an area if it's Class A real estate in Manhattan, you can kind of understand like the underground piece, but then when is it going to get drilled? Time value money. That is something you don't control when that development happens. You can't call Chevron and be like, hey, Chevron, I own a lot of minerals in this unit. Can you tell me when you're going to drill, or can you go drill it? They're going to be like, yeah, get lost, right? You have no influence on that as a mineral owner. And so these mineral funds go and they say, well, we track the cell phone signals of frac crews from Schlumberger, and we saw that there was a drilling pad drilled from satellite imagery 3 months ago. And there's some, a gravel company that we have intel from that gives gravel for roads that are, going to a drill pad. They just got a contract from Chevron in this area, and blah, 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 blah. And they can put it all together and go, we think it's going to get drilled in 24 months. And then they underwrite that based on 24-month timing. Sometimes it gets drilled in 3 months. Sometimes it gets drilled in 48 months. They build a portfolio that statistically hones in on their underwriting parameters. And, sometimes, the tailwinds align, prices go up, drilling happens earlier, and you get these phenomenal returns, and you don't pay for the development upside, right? It's just timing risk. That's the beautiful thing about the asset class. So a long-winded answer of saying it's complicated. You want to get with the right professionals. If you want to go down that road of doing a 1031 directly, I can get you with those professionals. If you want to invest into funds and pick a jockey that is going to build the right portfolio for you, I can help you, get into those funds with the right managers with track record and skin in the game for alignment and all those things. And then from there, it's like for that level of uncertainty or that risk, if you may, there is risk for sure, but risk adjusted to a lot of other things you can do in the market for the returns you're getting. A lot of us in the space think it's one of the greatest investment products in the world because, as Carl Brinsicki at Haymaker Minerals, he just launched a minerals fund to funds concept. I just had him on my podcast. His episode's going to go live shortly. He's one of the OG guys in the space. And he just said, what other asset class does Do you pay for once? You never pay any costs ever again. And then some of the largest, most well capitalized businesses in the world spend all their time and money and resources making your asset more valuable because it makes their asset more valuable. And you don't pay them anything additional. And then you get the benefit of technology innovation and all these things for free, essentially. So that's what's so cool about it. Time is your friend. The longer you own these things, typically good things happen, because who could have thought the shale revolution would come? Who would have thought AI data centers would infinitely increase electricity demand for natural gas? Like, who would have thought these things? And there's going to be more versions of this, and mineral owners ultimately benefit. They're at the top of the cap stack, and they're going to benefit from that. So it's a really interesting time for the space, Matt. It's a lot of fun to be in it. And, I always, a lot of us that are in it, we might be biased because this is what we do. We know about it, every angle of it. We eat it for breakfast, for lunch, for dinner. It's all we think about, but it's just a tremendous asset class. And we feel like everyone should have access to it and have some level of exposure to it. Again, I'll quote Carl in this episode I just did. He said, at a minimum, you should own some sort of mineral exposure as a hedge on your energy consumption. So the average individual might spend $4,200 a year on gas, right? And if you have gas heating in your home, something like that, do something that, do a $40,000-$50,000 investment in a public entity or a fund or something to where you're offsetting that energy exposure and you're getting yield. And if you like the asset class, you can do more for the returns because it's great returns. But at a minimum, that hedge on inflation for energy costs is just an attractive thing to have in the portfolio, right?
It's so funny. My grandmother has some mineral interests, and that's every time the payment, the monthly payment goes up, she says that, like, I know gas went up, but don't worry, we've got it covered. You could just think about, that's a great point. All of your energy consumption could be like, as that goes up or as you're paying more there, you could easily have offset that by owning an interest.
And if gas and oil prices go down, you save on the energy cost proportionally. And your monthly check might go down a little bit, but you're benefiting somewhere else. So you're covered in that capacity for sure.
Now, as people are thinking about, from a wealth transfer perspective, there's families that are saying, I need to organize my stuff, or I need to figure out how I'm going to transfer these things. Or sometimes it's not well planned and all you've got is just fractionalization kind of situations. What are either some mistakes people regularly make when transferring these assets, or what are the warnings that you have for people when it comes to, we think about this from a building, protecting, transferring wealth. What are the warnings and the mistakes people make?
Well, one thing, I think a lot of people don't know what they own. So actually, where we were introduced, shout out to Chase Daly, who heads oil and gas at Farmers National. They're the largest private mineral manager in the country. I have a great relationship with Chase, been working with his team for a long time. Like, you just don't know what you own, especially if you own a lot of stuff, right? If you're getting checks in the mail, and this is what happens, minerals start to produce, and people get checks in the mail. It's like, okay, I'm going to cash the check. This is good. Are the decimal interests correct with the oil and gas company? There's mistakes. I don't think there's malice out there where oil and gas companies like intentionally committing fraud, but you have to understand there's tens of millions of mineral owners, and your decimal interest in a well could be 0.0000786%. And what if it's supposed to be 0.0000797%? On a well that's producing tens of millions of dollars a year, that could be material to you on years and years and years. So if you kind of like have inherited something and it's just a hot mess, something's been in the family drawer forever and no one's looked at it, I think engaging someone like a Farmers National makes all the sense, because they're going to go out and figure out what you own, not only producing, but non-producing. If you own what's called open minerals or unleased minerals, there's going to be companies that approach you, oil and gas companies, that say, hey, we want to lease your minerals and have the right to drill them. Negotiating those lease terms, you need to know what you're doing, so you don't kind of get screwed out of potential upside economics. you want to make sure that you're getting paid correctly. If there's any discrepancies and a company doesn't know what to pay you, where to pay it, et cetera, there'll be money put in suspense. And you could have, there's so many stories, Matt, of very sophisticated mineral owners that start just digging through and cleaning stuff up. And they go, hey, we found 10 million in suspense. And then as soon as they clean up all the paperwork, boom, it gets released. Boom, 10 million bucks. Like, it's wild. And that's the job of a mineral manager, is to find all that stuff. And so there's a lot of inefficiencies and just not knowing what you own and just kind of getting visibility on that. And I think that's money well paid if you're not from the industry, to get that full visibility. And then from there, once you understand what you own, I'm not an attorney, but I think if you're trying to do estate planning and figure out how to pass it on, I think you need to speak with someone with that kind of expertise. There's a lot of different attorneys within Texas. I'm sure you know a lot of them with oil and gas experience that can help you out with that. And then separately, if you're looking to monetize them, there are a lot of groups who have raised capital, who buy mineral interests, who pride themselves in kind of rolling up their sleeves and buying the hairy deals. So they'll be able to go and kind of clean stuff up and buy it from you and get everything and paste that. Like, that's their job. And as long as there's a fair trade to be had and you feel like you're getting the monetary value you think is fair, that's kind of, you can pass on a lot of the heavy lifting to an industry fund that knows what they're doing, has access to all the right attorneys, can do the title, can do all those things to acquire them and take those off your plate. And that's, I think, as we have more and more generational wealth transfer, you're going to have more and more people, especially if interest gets smaller, that say, I don't really want to deal with this, right? It's either too small, or it's too complex, or whatever. I'd rather have the cash, and that's fine. It's a great asset class, but if some people just don't want to deal with it, or one sibling does and one sibling doesn't, like, hitting the eject button and getting the cash is just, it's an option. So I think there's never been more liquidity in the market. There's a lot of buyers, and that's another thing I'll say. If anyone's kind of thinking about exiting, I'd happy to be kind of the gatekeeper at the beginning of those conversations, either point you in the right direction or formally advise for you, because I know who the right buyers are for certain areas, and I can help maximize the value of your exit. That's one of the things I do as an advisor. So
that's awesome. As we wrap up, obviously, I'd love for people to be able to connect with you, listen to your podcast. Tell us, where can they find you? Tell us more about the podcast.
Sure. Email is tim@mineralsauthority.com. You can go to mineralsauthority.com as my website, just kind of an overview of what we do and the ability to schedule calls. There's all sorts of buttons on there. If you want to just kind of stay in tune with what's going on in the industry, just look up Tim Pawul on LinkedIn. I post anywhere from 1 to 4 pieces of content a day. Everything is specific outside of some philanthropic personal stuff that I do. Everything is minerals and non-op. It'll be news, it'll be repurposed content, anything you can think about from different angles, I'm posting about. And so I've kind of become the de facto newsletter of the industry, if you may. There's a lot of things, Matt, that aren't innovative. You would think a newsletter and stuff is not innovative in the world of 24/7 news, but in my space, it's quite unique. So a lot of people follow me on LinkedIn for that. And then as you get in my ecosystem, I have a monthly newsletter that kind of consolidates all that. And then for the deeper dive stuff, the Minerals and Royalties Podcast. I've been doing it since February of 2020. I'm getting close to 300 episodes. It's a weekly episode with a CEO, a fund manager, just usually someone running a company that has some sort of fingerprint on minerals and non-op. And we don't really spend the time to spell out the basics. We kind of just jump right in. It's really meant for someone who's kind of interested and diving deep, and it's deal trends and deal activity and financings and everything in between. So I have a blast doing that. And, I guess I spend 90% of my time in private meetings and calls. So I would love to, don't be bashful, reach out to the email, tim@mineralsauthority.com. Love to get to know you. What is your personal situation around minerals and non-op? what you're looking to do and whether I can help you directly or I can introduce you to the right people, I'd love to do that. And so I welcome anyone to reach out directly, and I look forward to building a relationship.
That's awesome. Well, this has been highly valuable. I've thoroughly enjoyed it. I'm ready to go put some money in minerals. I'm pumped about this, but also I can see how this would be super valuable for various families and people kind of trying to get their fingers and arms around what they've got or what they might want to use their money for. So thank you again, Tim. I really appreciate it.
No, Matt, thanks for having me on. I've really enjoyed getting to know you, and I know we're going to do a lot of reciprocal business and intros over the years, so I look forward to that.
Thanks, Tim. That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just so honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.